Hello and welcome to the Mutual Fund Show. I'm Neeraj Chan. Over the next 20 odd minutes, we'll talk all about index funds. Some of you would have heard of it. Some of you might have dwelt a little bit on it, but might not know it in detail. And I think in times like these, it is pertinent to at least have a discussion, if not some action, on index funds. So with that in mind, let me get in both of my guests on the show today. They need no introduction really with their organizations. Raghav Iyengar from Axis and Pratik Oswal from Motilal Oswal join in to talk about this very subject. Gentlemen, both of you, thanks so much for joining in. Appreciate your time. Raghav,
Thank you, Neeraj.
envisaged doing this conversation a couple of weeks back. Let's start off with you. What are index funds? Why should investors consider them?
So I think, thank you, Neeraj. I think this is a very, like you said, a very, very pertinent question in today's times. So index funds are nothing but passive funds. Essentially, they take away the element of bias of what we call active management bias, right? I think they typically track an index. Uh, I think the usual benefits of mutual funds largely apply to index funds. I mean, obviously, you're getting a diversified portfolio. You're getting a lot of transparency because when you buy an index, you know exactly which stock comes in what quantity. You have various types of indexes today. I mean, there are various index providers, the National Stock Exchange, the Bombay Stock Exchange, CRISIL, ICRA, all of them come up with various types of. So you can actually customize your portfolio to some extent. You can really get a lot of sector specific indexes. So you can really do a lot of customization, transparency, and of course, because it's not an actively managed fund, the costs are significantly lower. Uh, so in some sense, there are many investors, Neeraj. Why do people get into index? I think it's an idea whose time has come. This category has actually gone up 60x. I mean, it used to be a very, very small, negligible category, hardly 10, 12 years back. And today it's almost about 20, 25% of the total equity funds under management, almost about which is about 20 odd lakh crores today as of December end. Almost about 4.5 lakh odd crores of money is sitting in index funds today. Largely, even today, an institutional option. I think I'm not sure if many of your viewers know this, but if you are an EPFO customer, you subscribe to the Employee Provident Fund, up to 15% of your money goes into equities, and all that money goes into index funds, typically the Nifty and the Sensex fund. So it's a great idea. In fact, India has gone from actually being nowhere to now the fourth largest ETF market in the world. This year we've had almost the year 2021 we've had almost 160 new launches coming up and more coming by the day. So yes, it's an idea whose time has come. I mean, it's not an or. I think earlier, people would think that it's only an active management versus passive management. I think now a lot of investors, thanks to shows like yours, have realized that you need a mix of both in your portfolio. So it's active and passive.
Yeah, a combination of the two. Incidentally, if I'm not wrong, ETFs became the largest category as of end 2020, even if I'm not wrong. So yeah,
Yes,
that's
absolutely. Yeah.
has been crazy. Pratik, your thoughts really on the category and the need for the category in the current times.
Yeah, thanks, Raghav. I think he's sort of done the broad strokes, but the way I see index funds is that they're essentially very I would say simple products. They are all about simplicity. Today I think if you look at an average retail investor, they have a lot of options. They have hundreds of funds, they have hundreds of debt funds, and within each category also you have so many funds. So I think index funds are extremely valuable in the sense that if you want to buy a large cap fund or a small cap fund or a mid cap fund, you don't have to go around and trying to figure out which is the best fund. You can just buy the index, and that's good enough for a portfolio. So I think the whole idea behind index funds is that we all are talking about asset allocation as a concept, and index funds work for great building blocks for that asset allocation. So I think that's where really index funds come in. I think the simplicity is quite good, and what we've seen over the last few years is that back in the day, say 5-6 years back, I think even returns were lagging, but today I think even in terms of returns, I think index funds are on par with I think most funds out there. So I think that's where index funds side. I think they're good returns and I think very simple to understand. What we've also seen in terms of index funds is that they don't. Most people think of index funds as Sensex, Nifty, but actually that's a very small part of it. You have index funds across different sectors, themes. You have index funds in the international fund section as well. You can buy gold and you can buy silver as well. So I think if you look at say passive funds in general, obviously most people talk about Nifty and Sensex, but there's a whole world out there You can buy passive funds within commodities. You can buy under international funds, sectors. So I think really for someone who's looking at a multi-asset portfolio, index funds can be extremely effective. And also, I think the main benefits of index funds is also low cost. So I think more of your money is being invested in the underlying stocks. So I think in that sense, over the long term, it can make a meaningful difference to your portfolio. So I think that's where sort of index funds are. And I think historically, the education behind invest in index funds were not there. But I think that's also catching up with more and more fund houses coming in and more sort of education going in for index funds.
Pratik, do you, I mean, internally, since you kind of, if I'm not wrong, had this whole passive investing division amongst other things at Motilal Oswal, is there an ideal percentage allocation to a passive stroke index funds in an average investor's portfolio? We're not talking about the nuanced investor who understands equities and therefore can even time the in and out from equities and funds. But for somebody who's got a 9 to 5 or whatever, 10 to 6, and has this as a wealth building creation, which is investment in equities and in mutual funds, is there an ideal percentage of the portfolio that should be allocated to index funds because of the applicability and the cost effect?
Yeah, so I really think the problem is average is that you have people who are 100% in index funds and you have people who have 0% in index funds. I think average would be around 50, which may not be the right number, but I think it really depends on customer. I mean, as I said, I think overall I would say there's a theory of having a core portfolio versus a satellite portfolio. And I think a core portfolio is a portfolio which ideally you should not be touching for many years. If you're a young investor, you should be investing in it for 10, 15, 20 years. And that is where really index funds stand because you don't really worried about performance. It's always sort of within the or tracking a particular index. There is not really any need for you to sell your funds. So in that sense, if someone is looking at, say, you're looking to invest for 20, 25, 30 years, I think index fund can be great for that portfolio. So I think the core portion, which is not to be touched, that is a great area of the portfolio, say 40-50% of your portfolio, where you can use index funds. Obviously, it doesn't have to be just a Nifty or a Sensex. You can also have an international quotient out there. You can have some bit of commodities. Gold is, I think, been very effective in as an inflation hedge and also does well during bad markets. So and also I think now there's a whole sort of industry behind debt ETFs and debt index funds, which have got a lot of appeal in the market. So I think I mean, as I said, it depends on investor, but I think the core portfolio, however big it is, can be the one that's can be allocated to index funds.
Raghav, your thoughts here, and of course also the tenors, because I think Pratik referred to how people can keep this as a part of the portfolio for a long period. Your view may differ, but I think it's very important for people to understand that if they watch this show and believe that index funds are a great option, they also keep in mind the kind of tenor. And of course, Raghav, please couple that up with the risks to an index fund, right? I mean, either the risk of relative underperformance and therefore how to correct it, if you will, dwell a bit upon that.
So I'm a bit of a believer in that, as markets get more efficient, obviously outperforming the index gets to be a bit difficult, right? And this is something, Neeraj, we've discussed on your show plenty of times. I am in the camp that I think India yet has a fair amount of stock discovery left. So as I said, it's not an either or situation, it's an and. So, and coming to the amount of whether it should be core, satellite, and stuff like that, frankly, very difficult to put that into a public show like this because I think that's a conversation that an investor must have ideally with his advisor or with an expert to try and figure out how much of risk that he can take. And like Pratik rightly said, index funds are simple in terms of construction, but are reasonably bewildering in terms of the amount of complexity that you can build into this. So you can have maybe 50, 60 types. All the innovation, frankly, which is going to happen or is happening around equities now, because after SEBI came up with its portfolio criteria, it's become very simple on the active space, right? You have a large cap category, you have a large and mid, you have a small, you have a this thing. Whereas in indexes, you can literally, really innovate like crazy. And sometimes that brings a level of complexity too, which maybe the retail investor doesn't understand. Also, we have had this problem, and it's not only an Indian problem; it's an investor problem where people tend to sort of chase runs, right? So like I see a lot of interest today in small cap index funds, and I don't know whether the people are really coming in because they understand that product or because they're just seeing the last 1 year outperformance, especially with the broad based indexes. So that's a risk I feel that, yeah, please, like every other instrument, because it's an index, there's no active management. You're really buying a passive portfolio. There is no intervention at all. There is no fund management process. So you have to be really pretty much clear as to what risks you're willing to take. And like Pratik rightly said, it can be a core part of your portfolio, but then you
Yeah. Was am I the only one who can't hear Raghav properly? Pratik, did you?
Well, that's me. Yeah, yeah, I think he's having some network
Okay.
issues.
hello, Neeraj,
Okay.
sorry, I think,
No, no problem, Raghav. I think we just lost you a little bit in the
yeah, I'm
last.
so sorry. Am I back right now?
You should be back in a minute. Nevertheless, while we just patch that line, one final set of questions. Pratik, I didn't ask you about the risks because you look at this so closely. Tell us, because I think one key discovery in the last 12 to 18 odd months has been that, especially in the large cap category, the preference of investors towards active funds and paying those expenses versus choosing ETFs or index funds has greatly increased, simply because the challenge of performance has been so large out there. What are the risks to having a large proportion of your core equity investing portfolio mutual funds into index funds?
Yeah, yeah. So I think if yeah, I mean, as you said, I think if you see over the last 3 to 5 years time, and this is something that I think Raghav also mentioned, that Indian markets are becoming extremely efficient in terms of, I think stock picking is a lot harder today than it was say 5 or 6 years back. And I think the maximum action, at least institutions, happens in the large cap space. And every stock gets covered by thousands of analysts, thousands of hedge funds and all of that. So I think at least within the large cap space, the ability for you to find value has become a lot harder today than it was say 5 years back. Because of which I think a lot of investment advisors are recommending, I think at least in the large cap space, to have a Nifty 100 or a Nifty 50 fund. That can be a good way of I think playing the large cap part of your portfolio. But I think it's also extremely simple. You don't have to do anything. So I think there, at least what we've seen with data, is that that is a good way of I would say playing the large caps.
Hmm. Raghav, before we thank you, since I mean we've had a series of conversations around the the applicability of diversity of funds into one's portfolio, be it on the debt side, be it on the equity side. And we just spoke about what's the quantum of proportion and how it will be very individual to each person in the index funds. Is there, because both you and Pratik mentioned that as of now, an investor, when he thinks of index funds, is largely restricted to large cap Nifty, Sensex at best. And you just briefly mentioned about how the interest in small caps is rising. I'm trying to
Yes.
understand, to make it simple for the viewer here. If you were to advise, irrespective of what quantum of the portfolio goes into index funds, but within the index funds variety available, what are the basic index funds that an investor should go to if she or he is in the first 2 or 3 or 4 years of her or his investment cycle?
See, again, Neeraj, that's an interesting question, but yeah, I think typically you ladder it up with obviously the more broad-based indexes, the Nifty 100, for example, which is a mix of really top mega caps as well as emerging large caps into that portfolio. That's normally the first choice, and then of course, depending on your risk appetite, you ladder it up with if you want to get into mid caps or small caps or more other strategy kind of investments. There are various types. I mean, there are style indexes, there's a value index, there's a growth index, there's a quality index, and that's what I said. It can get a little confusing. So hence, I think this conversation ideally, Neeraj, yes, and yes, people have generally gone to large caps because they feel that large caps, like Pratik rightly mentioned, gets overcovered and it's difficult. But yeah, I'm in some sense yet a bit of a believer in active management. I think fund managers in India with research do provide some value. It's been a bit of a sort of a one step forward, two step backward kind of a situation. Last 1 year we've had indexes doing very well with service actively managed large cap funds. But if you take a 5 year track record, you will find that situation is very different. So as I said, I think it has to be a bit of a core. It's an and part of it. One thing which is very clear is this is a segment which is not going to go away in a hurry. I mean, many times people ask me, is this the fashionable thing? Passives are become very large. Is it just is it something like every other fashion in investments is just being talked about? I don't think so. I think there are massive advantages. I think if you look at life internationally, a lot of money is moved to passives again. And number three, I think thanks to a lot of work that people like you, platforms, many of our partners are doing, I think the popularity, if I may use the word, or the education of index funds is got much, much better. And of course, now if you put the final thing on top of that, you now have stuff happening internationally. And then, of course, you have now debt index funds also, which are now getting very, very popular again. So these are all interesting ideas that are getting built upon. So I think we are in the start of something. I think as you keep mentioning in your show, we are a 20 lakh crore industry, Neeraj. So we have a long way to go in terms of total size. And I'm sure in that size, I'm sure there's going to be place enough for both passives and actives to sort of work together for the investor.
Okay. Well, Raghav, thank you so much for being on the show today and giving us your thoughts. Really
Thank
appreciate
you.
your time.
Thank you.
Great
And,
having
and apologies for the connection, but yes, thank you, Neeraj. Thank you,
you.
Pratik.
Completely fine.
Thank you.
Completely fine. Well, viewers, so that's the lowdown on index funds. I would urge you, viewers, that there is no one size fits all. Part one of the point is that. In part two, yes, I know the focus on costs is very important. You've seen that show that we had done 2 years back with Saurabh Mukherjee and Clear Funds about how the quantum of return changes disproportionately in normal performing funds if the expenses are lower. But do consult your financial advisors before, as both of our experts said, before you go out and make a proportionate allocation into index funds as a part of your portfolio. But yeah, I think this show gave you a great idea of what the basics could be like. Now, Pratik, you've come up, or I think there is a proposal from your end, or a launch from your end, which is the Nifty 200 Momentum 30 ETF and the Nifty 200 Momentum 30 Index Fund. Can you talk a bit about what are these products, and is there a marked difference between the two? I think a lot of people would get confused, so please explain to us,
Yes.
because they also fall in the realms of the index fund category that
Yes.
we're talking about.
Yeah. So essentially, I think if you look at index funds category, as I said, there are many categories. You have your broad-based funds, large cap, mid cap, small caps. You have your sector funds, IT, consumer, all of that. You also have international funds, S&P, Nasdaq, and you also have, I would say, debt funds, which are obviously getting popular. I think within just the equity space, you have, I would say, the broad-based funds, but you also have a category which are called factor funds, which fall under the category called rules-based investing. What does that mean? That means based on predetermined rules, there's a stock selection process that happens within the underlying universe of stocks, say Nifty 500 or Nifty 200. There's two types of rules-based, funds. One is called quant funds, so I think you see a lot of quant funds out there as well, where the rule is not really known to the public. So basically, that's a secret sauce of the AMC, and based on that, the whole idea is to generate outperformance of the index. The other one is called factor funds, where the rule is completely transparent. So the investor knows exactly what the rule is that governs that particular factor. To give an example, for example, value. Value is pretty much very subjective, as a concept, but in a factor strategy, a value is completely transparent. So you know that in a value fund, you will always have stocks that have the lowest price to book earnings, or price to book value, or price to earnings. So that's a factor called value. You have quality, where you know for a fact that you will have a list of stocks that have very low debt to equity ratios and who are very high price in sort of ROE or ROCE. So these are certain rules that are globally standardized, and based on these rules, you have certain stocks that are selected in these funds. So Momentum is the fund that we're launching, which is one such factor. Essentially, factors are building blocks for an investment process. To give one more analogy, if you look at Warren Buffett, I'm sure everybody would have heard about him. His sort of investment process would be, buying undervalued companies, buying high, sort of low volatility, very stable companies. He would only look at large caps, which again is a factor. And also he would look at, stocks which have, high quality, high quality companies. So these four are his sort of investment processes, and you can actually buy, and these are sort of building blocks, and each of them is actually a factor. So Momentum is one such factor. So what Momentum means is that you would essentially buy stocks, or not you, but the fund manager or the fund, which is the Nifty 200 Momentum 30 index fund that we're launching would buy the stocks which have the highest momentum in the last 6 to 12 months time, and that would be a part of your portfolio. What we've seen is that momentum is a very accurate factor for outperformance. So ideally, factor funds are in between active and passive funds. So the idea behind factor funds is that they are able to outperform the benchmark, but also they're able to provide you at a very low cost, the cost of a broad-based index fund. So you're essentially getting best of both worlds. And momentum is one such factor where the rule is that you would only buy stocks which are doing well in terms of their price performance. So we're launching two funds. The index is exactly the same. It's the momentum index, and we are essentially offering two different formats. One is the ETF, and the other one is the index fund. So what we've learned from history is that a lot of investors choose one over another, and we want to basically give out both formats because we know that there are fans for ETFs, but they also have fans for index funds. So here we get to sort of so our customers get to choose between the format that they prefer.
Why would there be a choice for one over the other, Pratik?
Yeah, so very interesting. So we so I think 2 years back we were very convinced that people not convinced, but at least what the market says is that index funds are a lot more simple. You don't have to have a demat account. You can set up SIPs. You don't have to worry about the price on the exchange. But what we've seen over time is that there is a lot of at least a retail sort of base and also a lot of institutions and family offices. They actually prefer ETFs. So they prefer ETFs because they tend to be slightly more efficient, and also they want to buy it directly off the exchange, as opposed to I think going and to the AMC and then subscribing for units. So I think there are different sort of segments, customer segments for each product. And the whole idea here is that we want to be customer sort of driven, and which is why we're having both these formats for each of these customers.
Got it. One final question, Pratik. What kind of investors should go out and choose these products, these two launches?
Yeah, exactly. So the whole idea behind, I think, we'd already spoken about core versus satellite investing. I think core, as I said, can be, in an index or can be any sort of broad-based fund that you want to hold for a very long time. So these factor funds, at least globally, have been very sort of lapped up by advisors. So a lot of the advisory community really likes factor funds because they get to play factors in different market conditions. So just to give an example, in a bull market scenario, momentum tends to be an excellent factor. What we've seen in bull markets is that momentum tends to outperform the normal index by about 8 to 10%. So I think advisors are very sort of they love sort of factor investing, and they can sort of add this to their client portfolio to sort of increase returns. So what we've seen is just by adding a 15% allocation to say a Nifty 500 fund, you can increase your returns by 1 to 1.5%. So I think that's the whole idea behind factor funds, is to obviously costs are low, but also you're ensuring that at least if you hold it for a good 3 to 5 years time, then you can also expect some sort of outperformance. It's also important to understand that these sort of funds are not purely alpha funds. So I think there will be periods in time where there will be underperformance as well, just like any other actively managed strategy. So investors should keep this in mind. I think if someone tells you this will give you alpha, that is not right. There are points in time in the past as well where these funds have underperformed. So I think investors just keep that and need to have sort of a longer term approach when looking at equity funds, especially factor funds.
But it's like to leave an analogy before we wrap up the show. It's like you add a small cap or a set of small caps to your portfolio to add that extra bit of outperformance over a 3 to 5 year period. In the same way, you add these factor funds, so to say, to your MF portfolio in order to add that little bit of alpha. Even though alpha generation is on the core, but it does aid in alpha generation over 3 to 5 years.
I would say, the problem with small caps is that they're very risky. The sort of risk you're undertaking to get that extra performance, it may or may not be justified. Whereas in factor funds, if you look at the risk, it's exactly the same as a broad-based benchmark. So essentially, you're not really taking up excess risk. In fact, if you look at factors like quality and low volatility, the risk is a lot lower, and actually returns are higher than the broad-based index. So actually getting the opposite effect. So I think, yes, with momentum, especially, yes, the risk is the same, but we've seen that there is outperformance in the past 15 years. But I think the risk really depends on what strategy you choose. If you're looking at a low vol strategy, then you're buying stocks like, ITC and stuff, which very stable. Whereas if you're buying a momentum, then there is same risk as a Nifty, but the outperformance is there. So I think it really depends on what strategy you're looking for. But yes, the whole idea behind factor funds, as you said, is to add an extra layer of returns to your portfolio, which is why it sort of comes in the satellite portion.
Great. Thanks, Pratik. Great having you, and thanks for this explanation, and all the best with the launches.
Thank you so much, Neeraj. Thanks for having me. Thanks.
Now, the pleasure was ours, and viewers, thanks for tuning into this leg of the Mutual Fund Show.